right, futures pulling back from all-time highs on this Friday morning. 30 minutes to go until the official start of trading. I'm Katie Greifeld.
And I'm Sonali Basak. Matt Miller is off today, and Bloomberg Open Interest starts right now.
Coming up, another day, another tariff. President Trump announcing a 35% levy on Canada. And as such, stocks pulling back from record highs with earnings season set to kick off in a big way next week. And a rendezvous at the White House. Nvidia CEO Jensen Huang meeting with President Trump ahead of his trip to China. We'll see what that means for the stock.
Yeah, absolutely. Let's take a look at what it's doing right now, because we hit $4 trillion, didn't we, Katie, this week in terms of market value. It is pulling back. It closed above that valuation mark just yesterday. Jensen Huang had met with President Trump ahead of that trip to China. There's going to be a lot of readout of what the tariff strategy means for the AI semiconductor sector. Other Mag 7 stocks also lower this morning, Katie.
Yeah, certainly not helping out the S&P 500 at the benchmark level. But what is doing well this morning is crypto-related stocks surging as Bitcoin extends its record rally past $118,000. Riot Platforms, Marathon Holdings, and Coinbase all higher pre-market. It's risk on if you just look at this screen. A different story, of course, in traditional equities. That's with President Trump doubling down on his tariff threats. The president says that he's eyeing blanket tariffs on most trading partners while singling out Canada. In a Truth Social post, he threatened that 35% rate on some Canadian goods. And then you had Prime Minister Mark Carney responding on X, saying that the Canadian government will defend its workers and its businesses. Joining us now is Bloomberg Washington correspondent Tyler Kendall. And Tyler, give us some context here, because 35% certainly sounds steep, but then you consider the USMCA exemptions, and I think that covers most Canadian exports.
Right, exactly, Katie. And that's a really important point to make here, because when we do look at the bulk of those Canadian exports, they are USMCA compliant. Data shows us it hovers somewhere around 60%. And a U.S. official does confirm to us here at Bloomberg News that those USMCA compliant goods will remain exempt from these future tariffs. So in theory, this could lessen the blow for Canada moving forward, but it no doubt is not welcome news for the Canadian Prime Minister Mark Carney, who's been trying to leverage, I think it's safe for us to say, his relatively warmer relationship with President Trump compared to his predecessor as they try to race ahead to this August 1st deadline. The thing here, though, is that this White House has a range of concessions that they are looking for when it comes to our northern trading partners. If you look at President Trump's letter from yesterday alone, he talks about fentanyl concerns, but also heightened market access for U.S. dairy farmers. And then we can't forget that just last month, negotiations basically went off the rails because of the White House's dismay that Canada was set to collect revenue from its digital services tax, and ultimately Canada had to abandon those plans just to get the talks back on track. Katie and Sonali, also important to remember here, of course, the sector-specific tariffs with the news this week of that 50% tariff coming on copper on August 1st. That's going to hit Canada particularly hard. They're one of the top exporters of copper to the United States, which only complicates these negotiations further.
When we talk to investors on the set every day, they say they're assuming a tariff rate in the mid-teens level. And then you had the president telling NBC that we're just going to say all of the remaining countries are going to pay, whether it's 20% or 15%. 20% is higher than what a lot of investors are expecting. What are the chances they stay that high?
Right. So that's sort of the big question here. This is the first that we really have heard President Trump threaten a higher global baseline tariff. Our understanding up to this point is really that it was going to be at 10%. And our analysts at Bloomberg Economics say that as of now, the average U.S. tariff rate is already up 10.9 percentage points from when President Trump took office. It hovers around 13.3%, according to our analysts. So now take into account that perhaps that baseline could be even higher, plus some of these individual countries are facing tariffs as high as 50%. Look at Brazil, look at the European Union potentially, as we wait for some sort of updated tariff rate there, as President Trump does reiterate that he's going to be sending the EU a letter in perhaps today, the coming days, he previously said earlier this week. We really are looking at President Trump doubling down on his broader tariff plans.
Tyler, we thank you so much for joining us this morning. That is Bloomberg's Tyler Kendall, all over every move in Washington. Now, one company shrugging off the effect of President Trump's tariffs, surprisingly, for now, is Levi. Shares are rising on a positive earnings report. Levi CFO saying, quote, given our strong first half and continued momentum across the business, and despite higher tariffs, we are raising our full-year revenue and EPS expectations. For more, we are joined by Bloomberg retail reporter Lily Meyer. Why is Levi able to weather the storm with the tariffs, especially given that you would expect input costs to go up so much? Is the consumer holding up just that strong?
Yeah, I think Levi's strong revenue is really helping it navigate the tariff impact. They beat estimates, they raised their guidance, and so I think their strength in their DTC strategy and in their product is really driving their strong performance.
Yeah, it's really interesting because heading into yesterday's close on a total return basis, the stock was already up almost 16% year to date. Of course, having another good day in the pre-market right now. We'll see if that holds through the actual cash trade. But give us some context here. What is setting Levi Strauss apart when you think about some of its peers and the similar issues that they're dealing with as well?
So Levi's was a really interesting stock to watch right now because they were one of the first retail companies to report right after President Trump announced his Liberation Day tariffs. And in their first report, they didn't include the impact of tariffs. So this is the first time we're really seeing how they can navigate tariffs. They have a relatively new CEO, Michelle Goss, who's led them in this DTC first strategy. So they're prioritizing selling on their own platforms, which they've seen a lot of success with. They're also branching out in areas like tops and dresses, and they've seen a lot of success there as well.
Lily Meyer, we thank you so very much from Bloomberg News on the retail industry. And later today, catch an interview with Levi's CFO at 2 p.m. New York time. And earnings season officially kicks off next week with big banks and Netflix leading the charge. I'm getting my spreadsheets ready today. Joining us now with more, Bloomberg Equities reporter Alex Semenova. Starting with the banks, we start on Tuesday, of course, with J.P. Morgan and the big, more Main Street focused banks, then followed by Goldman and Morgan Stanley. Trading revenue is expected to do really well. But is that going to almost mask what we might see from the rest of earnings season? If the banks do well, can the assumption be that the rest of corporate America is also doing so?
That's certainly very possible. There are so many sources of optimism when it comes to the big six banks that are kicking off the earnings season next week. Of course, as you mentioned, analysts are expecting an increase in trading revenue across the board. Those segments are expected to benefit from those big swings that we saw back in April from President Trump's tariffs. In equities, Goldman Sachs is set to lead with a $3.7 billion haul forecast, followed by Morgan Stanley. And then in fixed income, currency, and commodities, J.P. Morgan is set to take the top spot. And plans, of course, by U.S. regulators to ease capital rules are seen as a massive tailwind. That's, one of the tailwinds that everyone has been citing, and potentially set to unlock as much as $70 billion worth of capital. Investors will be listening to guidance from corporate executives, of course, on how they plan to allocate that capital to boost profits for banks. And going into this earnings season, a lot of equity strategists have been saying go long financials. It's a segment that's been doing really well. The S&P 500 financial sector up 9% this year.
And the regionals also crushing it. I would ask a version of your question, too, about big tech, though. Can the rest of earnings season go well in terms of sentiment if we don't have big tech really show up here? Netflix kicks us off next week. They have been such a bright spot in this market, and it feels like they're firing on all cylinders here.
They are, Katie. Of course, Netflix is up 40% year to date. It's up some 50% from its lows back in April. So valuation is very much a concern. Seaport Securities downgraded the stock, specifically citing valuation, saying that they have really high expectations baked into the prices. But the expectation for now is that they will deliver on earnings. Bloomberg intelligence analysts say that the company is in for a gangbuster second half of the year. They're expecting solid revenue gains even during a time that has been seasonally weak for Netflix. They see a 15% increase in guidance and a 33% increase in operating margins. So they're, for now, expected to do quite well.
All right, we'll see if they can deliver. The stock is up 40% year to date, which is nuts.
A lot of great new content. Have you guys noticed this on Netflix?
I haven't been watching much Netflix, but I've been told that there are a lot of good news.
I hear. Bloomberg Intelligence tells me that their content slate is really good.
We'll have to tune in.
Yeah, I would trust them with my life.
Rami Malek A lot of Rami Malek movies and shows, I've got to say, if you're looking for a weekend binge.
The
I'm adding that
generational
to my weekend
talents.
plans.
Let's talk about airlines, because we got Delta yesterday, really knocked it out of the park. What stuck out to me was that you actually had United outperform Delta yesterday. Stakes, it seems like, have been really raised just in the past 24 hours when it comes to next week's airlines earnings.
What's interesting, though, Katie, even though United Airlines outperformed yesterday, they're actually expected to report second quarter earnings that could soften on slower revenue growth. That could be offset, though, by lower fuel prices blunting the impact of that. But overall, the theme of this earnings season is that the expectations are really low, so companies are likely to beat on that. Obviously, Delta is an example of that, with the CEO saying that consumers are shrugging off tariff headlines, that they're kind of desensitized to them. And also, President Donald Trump's tax bill is expected to boost spending for air travel. That could be something that we see from United as well.
It feels like if you give any guidance at all, that's good enough. I'll note that the Delta guidance that we got yesterday for the full year, it was lower than what they were looking at in January, but they gave it, and that was enough. So we'll have to see how their peers fare. Alexandra Semenova, great roundup as always. Let's quickly check on these markets right now. We did it yesterday. We hit an all-time high for the S&P 500, and we're waving it goodbye right now. The S&P 500 down about 0.6% in the pre-market. Those trade fears re-entering the equity scene right now, and you can see that in the NASDAQ 100 as well, and especially in the Russell 2000, down about 0.9%, Sonali.
Right, those new tariff rates that are being discussed for global tariff rates are a little higher than what a lot of people are expected, but clearly the president is seeing that the market can stomach just a little bit of this pain. Now, coming up, Apple planning an ambitious pipeline of new products for the first half of 2026. I know I need a new phone. We're going to talk about what's going on with the company next. This is Bloomberg Open Interest. And now to high interest, a look at what's making headlines around the world. Driverless Tesla taxis are coming to California and Arizona. The news comes on the heels of last month's limited robo-taxi rollout in Austin. CEO Elon Musk predicted that robo-taxis could launch in the San Francisco Bay Area probably in a month or two. And Apple is planning an ambitious pipeline of new products next year, including a new low-end iPhone, multiple iPads, and upgraded Macs. It's part of a push to generate more consistent revenue growth. Analyst Walter Piecyk joined Bloomberg earlier to talk about the company's AI challenge.
AI in general not only is a missed revenue opportunity, but if you're not a major player there and you're one of these large companies like Apple, Google, whoever, that in itself can disrupt you. And they are clearly far behind. They overpromised a year ago, and that's being kind to call that overpromising. They said that they were going to have all of these AI features. None of them developed. We all use Siri. It still is not a good service. This is a real risk to the company.
And it's hard not to watch Nvidia. Nvidia CEO Jensen Huang met with President Trump at the White House yesterday. The meeting is just days before Huang leaves for China. He has been vocal about the need for U.S. companies to access the world's largest semiconductor market. And for more on Nvidia, we are joined by Bloomberg technology co-host Ed Ludlow. Ed, big week in Sun Valley. Nvidia hitting $4 trillion here. A lot of questions about the future of AI. What do we know about the meeting that Jensen had with the president and how it could potentially help move forward as the U.S. and China talk through their newest relationships and try to figure out the way forward for the AI industry?
Well, the truth is we don't know what they discussed. Sources confirm that there was the meeting, and we also know, based on our reporting, that Jensen Huang will continue on to China next week for a prominent industry event where he's due to meet with high-ranking Chinese officials, including the commerce minister. It was interesting. Jensen Huang gave an interview on MSNBC this week where he likened the American technology stack to the dollar. The dollar is the world's reserve currency, and he feels that Nvidia's technology, but broadly American technology, should be treated in the same way, that the world should rely on it, and that includes China having access to it. What we don't know is what happens next with a China-specific product for Nvidia. There have been reports that a specific chip designed and engineered from the ground up could come at the end of the third quarter, but Nvidia's not talked about it. What Jensen Huang has been consistent on, and this relates to his meeting with the president, is super consistent that Nvidia is an American company and it obeys American laws. So you just don't imagine that Nvidia is going to do anything unilaterally in China without keeping this administration posted on it.
Yeah, it seems like he is going on a charm offensive in both countries. Our reporting shows that he's scheduled to meet with the Chinese Commerce Minister, among other senior officials. So we'll watch that situation closely. We're also watching Apple very closely. Ed, we just heard on Bloomberg Surveillance from that analyst from Lightshed who is making the case that Apple needs a new CEO here. I was talking to Mark Gurman about it on the close yesterday. He poo-pooed the idea, but what does the chatter in the tech industry that you live in sound like around that point?
Yeah, I mean, Tim Cook has been here this week in Sun Valley, along with all of his sort of mega cap tech peers. I haven't watched back that interview yet, but John Ferro did promise me, he asked, will you give us a short list then? Because I think people find it very hard to see who around the world of technology would jump into Tim Cook's shoes. Bloomberg reports so regularly on the change in lieutenants, right? The COO this week retired and his number 2 stepped up into that role. We've had a new CFO in the last 12 to 18 months at Apple. But being the CEO of Apple is a very different kettle of fish. So that's interesting. And then we have the reporting that Apple's now going back to what it's done historically, much more aggressive in being quicker to bring refresh to market on the devices side, because that's been a part of the story, right? We've all been waiting around for AI to happen. That hasn't gone so well for Apple, but they've also been slower to roll out new generations of iPhone, iPad, and Mac. And based on Mark's reporting, that's coming in the spring. And that's part of the strategy, it seems, to return to more consistent revenue growth.
Yeah, exactly. Our Mark Gurman reporting that Apple's planning new MacBook Pro, iPhone 17s, E, and iPads by early 2026. But is that what investors want to see? I mean, consumers are one thing, Apple customers are one thing, and then there are Apple shareholders, and it seems like they're just mono-focused on what's going on with AI specifically.
So in the first half of this year, probably the first quarter at least, the stock really traded on tariff and headline risk around trade. More recently, and we saw this with WWDC, literally in that session during the course of the presentation, there was disappointment that we didn't hear more about the pure play artificial intelligence tool for a consumer in the form of Siri. There were some really important milestones, Apple allowing developers to use its in-house LLMs as part of app development, but that is what the street's still waiting for. And so even with the reporting on the device refresh for the spring, it's still the focus of the street when they're going to be competitive vis-a-vis a ChatGPT or a Gemini or a Grok or a Claude for Anthropic.
I also want to point out that throughout the week, you have been at the summer camp for billionaires, Sun Valley, Idaho, for the Allen & Company conference. And there you wrote about Scott Bessent's address to the crowd. Really interesting to hear about the Treasury Secretary comparing the two most unlikely people to be compared, George Soros and Donald Trump. The idea of patience is pretty interesting here because a lot of Wall Street has relied on Bessent to kind of preach patience. And it looks like from your reporting that that is a very similar relationship that he is building with the tech community too.
So what sources told me was this was a moderated Q&A late on Wednesday morning. And he was asked, compare your current boss, Donald Trump, to your former boss, George Soros. Bessent did 2 stints at Soros Management, right? And he said they're very similar in their ability to do deals, but they are both impatient. And he said that as Treasury Secretary, I counsel and advocate patience to the president. He also talked a little bit about his outlook for rates, which is quite interesting. He said we basically see 2 cuts to rates, one full cut, one half cut in the balance of this year because of the strength of the economy. But the nuance in what he was saying, sources tell me, is that he doesn't expect rates to go back to where they were in the pandemic, right? Which is kind of what the president's been talking about. What he sees is rates kind of going back to normal but elevated levels that they were pre-pandemic. And the final bit that we heard him discuss was he was asked about Elon Musk's political party, the American Party. And what sources told me was he said, what party? And then joked that Elon Musk could get votes on Mars in the future, a reference, of course, to Elon's ambitions for humankind on a different planet. But you're right. This was about him balancing his persona with the investor base. He's been a long-running attendee at Allen & Co. And his loyalty to the president. And he was very praising of the president's ability to do a deal, find problems, find fixes.
It's the America Party, Scott Besson, if you're watching right now. I don't think that he's filed any paperwork, but Ed, fantastic reporting. Really appreciate your coverage out of Sun Valley this week. That is Bloomberg Tech co-host Ed Ludlow. Let's take a check on futures right now. Ahead of the opening bell, we are just minutes away, and you can see those all-time highs. Unless something amazing happens, it doesn't look like we're going to get a fresh record today. The S&P 500 off by about 0.6% in the pre-market, Sonali.
It brings us into the red for the week, actually. So we'll be snapping, Katie, about 2 weeks of gains with the new tariff threats here.
Well, that's the thing. When we're at these record heights, we need some fundamentals to push us forward from here. We'll discuss some of those fundamentals with Ann Barry. She is the founder of Threadneedle Ventures. She'll tell us why she thinks Meta's ad strategy will be a win. That conversation coming up. This is Open Interest.
Big tech's down, but crypto stocks are up ahead of the opening bell. Riot Platforms, Mara Holdings, Coinbase all higher in the pre-market, rising as Bitcoin extended its record rally past 118,000. Crypto, it's making its way more and more, Katie, into the public markets. It's worth paying attention to. They're the ETFs, but of course, one by one, you have SPACs and you have all sorts of listings for these Bitcoin treasury
companies.
Crazy.
So hot right now. Yeah, it's interesting to see Bitcoin and, of course, the crypto equities up today. They're not following the stock market. Maybe they're following gold. You do have gold higher by about 0.8%. Maybe that's the correlation underway, because I don't think Bitcoin has any fundamentals yet. I don't think it has any cash flows, but we're going to talk about equities a lot in the next 4 minutes, because that's where the opening bell is. Ann Barry is joining us. She is the founder of Threadneedle Ventures. That conversation up next. Don't go anywhere. This is Open Interest. We are just moments away from the start of trading. Welcome back to Open Interest and welcome to your Friday. I am Katie Greifeld. You take a look at futures right now, not too much of the Friday feeling when you take a look at the S&P 500 down about 0.5%. When you take a look at the NASDAQ down about 0.4%. And boy, I don't even want to look at small caps right now. As Sonali noted, if these levels hold, if these losses hold, that will wipe out weekly gains for the S&P 500 one day after we hit that record high. The Nasdaq 100 is already there, looking at losses on a week where we saw Nvidia reach $4 trillion in market cap for the first time. But one company can't hold up the entire market. But in any case, you do have people ringing and clapping at the opening bells at the NASDAQ, at the New York Stock Exchange on this Friday. If we take a look at the single stock level, do we have any good news?
It's not looking, actually, it's looking a little better now. We were lower for our Nvidia on the morning. We're actually starting to turn around. Let's see if it holds. Remember, Nvidia closed above $4 trillion in valuation just yesterday. CEO Jensen Huang was seen at the White House ahead of his trip to China. And we'll be keeping an eye on the trade today because, of course, as you say, one stock can't hold up the market forever, but maybe it might be the one that drags it down today.
Well, while Nvidia decides what to do, let's take a look at Levi's, signaling strength in the face of tariffs, saying sales growth is expected to have a bigger impact, coming out with a guide that was much better than expected. And you can see that in shares. Levi Strauss shares up about 10% as trading kicks off. This was a company that was already up about 16% on a total return basis year to date, much higher than that right now. We'll continue to follow that story. But let's zoom out here because it seems like investors are counting on U.S. stocks to rally on a robust earnings season before the market loses steam towards year end. That's according to Michael Hartnett of Bank of America, who wrote in his latest note that, quote, no one is worried about the economy or valuations. Let's discuss with Ann Barry. She is founder of Threadneedle Ventures, joining us on set. Great to see you in person.
Happy Friday. I've got that Friday feeling, even
Friday.
if the market doesn't quite.
I know. Well, a lot can happen between now and 4 p.m.,
Yeah.
so fingers crossed. But let's talk about that idea. You maybe see some concerns right now, but when it comes to the economy, when it comes to valuations, Michael Hartnett says no one is concerned. Are you?
I am, and can we take Delta as just an example for
Yes.
why I think the narrative and what drives earnings season success is going to be really bizarre this earnings season. Think about what happened. Delta came out and basically said, we have got the least worst possible state right now. You know, the worst of the uncertainty, and I think a lot of it was a reference to the Middle East, sort of in their perspective, being behind them. But how extraordinary that share price rallied as much as it did, simply because it said we're willing to put out some guidance at a level materially below where it was at the beginning of the year, and yet we saw the share price rip. That to me is emblematic of what Michael Hartnett is saying in his note. Not that no one worries, but I think we've sort of persuaded ourselves that, you know, not terrible news is a good outcome.
You know, it's interesting, to your point, Delta is still down 8% on the year.
On the year, right.
And so when you look at the broader earnings season, is it going to be a very barbelled season where you're going to see some blowout effects from things like bank trading, but other companies really struggle through this tariff strategy?
I think so, but I also do think that I think the market is looking at the tariff situation and saying we just don't believe, right, the outcomes are going to be as terrible as they were. So I think there will be some sort of barbell. I doubt we're going to see the massive, like 30% in one-day extremes we saw before. I don't think we're going to see the catastrophic drops either.
I just want to stay on Delta because I also thought that was a really interesting moment. I want to put some numbers to what you were talking about when it comes to their forecast. They see an adjusted profit of $5.25 to $6.25 per share a year. That, relative to their forecast in January, as you pointed out, their forecast in January was $7.35. It's just the fact that they gave guidance at all. Also interesting in Delta earnings was the fact that it was premium, it was international, that was really driving results. It wasn't economy, it wasn't the back of the plane. And when you think about what that says about the economy, how does that factor into how you're thinking about stocks such as Ulta, for example, which I know that you like and which is very reliant on consumers?
It is, and I think Ulta, and we've talked about Ulta on this show before, and I went in and I bought it when there are real concerns around execution. Merchandising wasn't going as well as it had done historically. David Kimball was on his way out as CEO, and we've now got Keisha Stillman in there. And I held on to that stock, and I held on, by the way, even when Berkshire Hathaway went in and then went out. Do you remember when that happened? And I really believe that Ulta could do something around premium products, that what everyday consumers, but also more affluent consumers, want is a destination that they can go to where they can actually feel and touch the product and sample it and try it on in a premium sort of environment. And I think Ulta is delivering on turning around its story by leaning into that. And by the way, it just announced yesterday it's buying Space NK, which is a premium retailer in the United Kingdom. I looked at actually investing in that in 2018. That to me is completely on strategy and a sign of what I think it is capable of doing.
Oh man, you are making me want to talk about M&A. But before we get there, I want to show you another barbell. I want to show you what's happening in the Magnificent Seven, because you see companies going in different directions. I believe you like Meta, but Meta has been up more than 22% this year. What more upside do you see and why?
Do you know, I would describe this as I've been in Meta, we've all been in Meta, right? You have to be exposed to Meta. But I kind of got religion on Meta while I was at Cannes Lions a couple of weeks ago. And the reason is I was with all of these CMOs and these big advertisers and media businesses, and everyone I spoke to, and I said, who is your partner of choice? It was Meta over and over and again for two reasons. Number one, I do separately and independently, I am bullish on what they're doing with their ads in WhatsApp strategy. And I say that because I actually invested separately in a business called Community.com, which is SMS to consumer. Works a lot of sports teams and brands to get text messages to consumer, because we're so saturated with email. Our open rates and click rates on things like text, which are more intimate, are actually showing wins. And I do think that Meta will deliver on that through WhatsApp specifically. The other thing is enrollment in Advantage Plus, adoption of their AI tools is going up significantly, and they're just starting to monetize Reels. So Meta, where I was like, ugh, it's run up, it's expensive, I now look at it and say it's trading at roughly 16 times EBITDA. Right, I'm a private equity girl. I've seen take privates happen for businesses without their moat, without their AI capabilities, without their cash flow profile trade at those levels. And so I look at Meta going, you know what? The valuation, it's not for the faint of heart, but it's not crazy either.
Not for the faint of heart, not crazy. 30 seconds. I have to get your opinion on what you make of the acqui-hire spree because, boy, that looks expensive.
Yeah, it does look expensive, but it's expensive everywhere. And by the way, CapEx is expensive too. So I think they have to do it. I sort of wonder whether it's going to end up going the way the banks have gone and try and hire these analysts into their private equity programs. At some point, everyone says we've got to stop because we're hurting ourselves. But the war for talent is global. The war for talent is between startups and big tech. And the big money is going to keep getting thrown around.
Yeah, and it's across industries as well, which Sonali knows well. And it's always great to see you. That is Ann Berry of Threadneedle Ventures kicking us off to the opening bell on this Friday morning. Let's take a look at how we're faring about 7 minutes into the session. And I'll be honest, it doesn't look that good. If you take a look at the S&P 500, we're down about 0.5% right now. Only 39 stocks are in the green right now, fighting to bring us higher. We have Nvidia, that certainly helps. Amazon, Costco a little bit as well. These are your biggest points contributor. But then you take a look at the downside, and we have more than 400 in the red, led by Apple, Meta, Microsoft, Broadcom, Tesla. The list goes on. When you have that many big tech names falling, even if just by a little bit on a percent basis, it's certainly going to hurt. And that's what we see at the sector level as well. A big, broad-based sell-off, not a single sector in the green right now. Energy is your relative best performer, still down 0.2%. You go down the list, healthcare, real estate, and materials off by more than 1% right now, Sonali. You add it all together, the index not having a great end to the week.
Yeah, we are ending very poorly today and probably down for the week. So coming up next, we're going to talk about exactly what's happening in some of those sectors, particularly Nvidia CEO Jensen Huang making a stop in Washington en route to China. We're going to discuss his meeting with the president next. This is Bloomberg Open Interest.
Welcome back to Open Interest. A quick check on the wipeout underway in the stock market right now. Just about 12 minutes into the session, you can see the S&P 500 down by about 0.6%. Big tech not too far behind. The Nasdaq 100 off by about 0.5%. It's the small caps that are the biggest losers right now. They were the biggest winners yesterday, relatively speaking, but currently the Russell 2000 off by about 0.75%. I don't know why I said it like that, but let's get to our top calls. It's some of the analyst action in focus this morning. And first up, Canada Goose getting upgraded over at Barclays. The analyst over there sees better margins and says that the coat maker is, quote, relatively insulated on tariff exposure, which is cute because they make coats. Next up, Freeport McMoran is getting downgraded over at UBS. The firm expects a softening in demand and fundamentals. And finally, Texas Instruments is getting raised to a buy over at TD Cowen. The firm says the chipmaker is uniquely positioned as the industry cycle improves, but shares off slightly this morning, Sonali.
And speaking of chips, so interesting. You're seeing a turnaround in Nvidia shares this morning. Nvidia CEO Jensen Huang met with President Trump at the White House just yesterday. The meeting is just days before Huang leaves for China. He has been vocal about the need for U.S. companies to access the world's largest semiconductor market. Now, Bloomberg Intelligence Global Head of Technology Research, Mandeep Singh, joins us now. And it's interesting. We came in this morning with a little bit of weakness in Nvidia shares. You are now looking at Nvidia hitting another intraday high. This is a company that just hit $4 trillion in market value. It feels like the love won't stop. What's going on?
Well, I mean, now we await another earnings season, and I feel we are in some sort of an information vacuum when it comes to tariffs specifically, because we know tariffs are coming back. How it's going to trickle down to the likes of Nvidia and pretty much the entire tech complex, I think we need to hear that commentary from the companies themselves. But look, when it comes to China, I mean, Nvidia wrote down their China revenue last quarter. The guide completely takes out China revenue. But in the end, when you think about the top players when it comes to LLMs, 5 of them are here in the US, the other 3 or 4 are in China. And those are some of the heaviest spenders on CapEx.
Right.
I mean, just to put it in context, US hyperscalers are spending about $325 billion in aggregate CapEx this year. Chinese hyperscalers are spending less than 30 billion. Still, they have some of the biggest LLMs, so less than 10%. And that's where Nvidia sees so much potential in selling to China, because they will ramp up their capex, and Nvidia wants to participate there.
And that factors into what I understand Jensen Huang's argument to be when it comes to restricting their chip sales in China, basically saying to the administration that if you restrict us in China, that's just going to allow some of their homegrown chip makers to really rise up and sort of take some of that opportunity.
Yeah, and look, I mean, Nvidia has been touting the sovereign opportunity. They signed a deal in Middle East. But to me, China is the biggest sovereign opportunity because they have the LLM companies. Everyone else is sort of thinking about creating their own LLM, whether it's, Middle East, India, or in Europe you have Mistral. But the biggest LLM companies outside of the US are in China. And they are the ones who are constantly training their models, who are deploying their models for all sorts of use cases like ChatGPT type of apps. And so you need the most compute over there. And that's where I think it makes a ton of sense that they want to sell even the deprecated chips to the Chinese market, so at least they can generate some revenue.
Mandeep, we thank you so very much for your time. Happy Friday to you. Of course, it's a busy week ahead. I hope you get some rest. That is Mandeep Singh from Bloomberg Intelligence. And coming up, looking forward to this conversation with you, Katie. Blackrock is launching a new ETF. That's the first of its kind. We're going to speak with Daniel Prince, Blackrock's U.S. head of iShares, next. This is Bloomberg Open Interest.
Welcome back to Open Interest. It's time now for ETF Friday, and this week, BlackRock launched the industry's first ETF that tracks the S&P 500 that excludes the index's top 100 stocks. The idea there being it's a way to give investors diversification for their large cap holdings. But you have Bloomberg Intelligence warning that the fund may struggle to gather assets given that it excludes what have been the world's best performing stocks. And joining us now, I'm pleased to say, is Daniel Prince. He is BlackRock's U.S. head of iShares. So that's the Bloomberg Intelligence view when it comes to this new ETF. What does BlackRock see as the use case for a product such as this?
Well, Katie, great to be with you today. And if we take a step back, over the last year, we've been really committed to building out a toolkit for investors to really navigate the sort of rise of U.S. mega cap and large cap dominance. And what we're trying to do here is really offer investors that precision to really fine tune what has become, the biggest part of an investor's portfolio, U.S. large caps. And as you mentioned, the shape of the U.S. market has really changed with the performance of the top really outperforming the rest of the S&P 500, really needing investors to take stock in how they approach building their allocations. And what our recent launch in the iShares S&P 500, where you exclude the top 100, is that toolkit to really allow you to do that.
How much is this an acknowledgement of the worry behind the concentration in the stock market? When people look around, they say, well, a lot of this is being fueled by the ETF industry, given that, BlackRock has multiple ETFs that track those very popular biggest names. So what does it mean for market structure purposes to be able to provide that diversification if so much money is just flowing to the top 20?
That's right. I mean, you just spoke to how, mega caps are playing an outsized role in markets today. When you look at the top 20 stocks, they're about half of the S&P 500, and over the last 5 years have drove about 55% of that index returns. You also think about the reasons why that's the case, where mega cap stocks have these wide economic moats. They've seen stronger revenue growth over the last few years, really showcasing why that performance has been strong. But as you alluded to, when we think about the iShares toolkit, it's about all investors. And what we've noticed is many investors are looking for ways to diversify away from that. They're looking at their exposure in their portfolio and looking for ways to take a step away from that. Whether it's areas like divesting from tech or getting into other, more attractive fundamentals. This is part of the toolkit to help, diversify away from some of that mega cap exposure.
And Daniel, I want to talk about this theme a little bit more because I hear what you're saying about diversification, but it feels like BlackRock has really been leaning into just giving you pure play mega cap exposure. I think about some of your products, Top T, for example, that tracks the 20 largest stocks. I'm taking a look at the notes you sent over to our producers, and you actually say that the average advisor portfolio is meaningfully underweight mega caps today. And I have to say, I haven't heard that one before. So just talk about that a little bit, because if you invest in the S&P 500, for example, you're already very exposed to mega caps.
Yeah, that's right. When we took a look at the data, when we looked at asset manager models, when we dove into the analysis around large cap blend active funds, relative to the market, what we noticed is the average was underweight those mega cap names. And what we're trying to do is empower investors to take a view. And ultimately, the goal here is to be more precise within large cap. It's not one monolithic approach to investing anymore. And what we see is our recent launch of XOEF pairing neatly with our existing ETF, OEF, really allowing investors to start tackling US large cap in a more intentional way and in a more modular way, and really looking at their own portfolios. Ultimately, this comes down to tailoring precise portfolios for growth opportunities, but also balancing out the risks as well.
Really interesting. And given that you are the head of product over at iShares, I want to talk about what you would and what you wouldn't launch underneath that umbrella. We have a great big take on the Bloomberg terminal today, and it's all about the rise of leverage single stock ETFs. They've been very, very popular with individual investors in particular. I know that BlackRock has some leverage products, but would you go as far as launching a single stock version?
What I would say is, our mission is to really help investors invest more efficiently. We do believe in investor choice. We do believe in providing greater access, and we provide, making investing easier and making investable more affordable. And we do believe that, the investments that we put out, need that sort of merit behind it, and that they have the quality that iShares stands behind.
So Daniel, is that a yes? Is that a maybe? Is that a no?
There's areas of the market that we haven't gone for various reasons, and we think about building better portfolios. We take stock in sort of investor outcomes and expectations when it comes to product innovation.
Are you worried at all about what some of these products are doing to the market? There has been a flush of retail interest into what had traditionally been considered pretty risky products, right? Is this a good thing for the market because of investor education, or is it a bad thing because people are taking on undue risk?
No, you really hit the nail on the head. Ultimately, this comes back to investor education and understanding what you own. We do believe in the democracy of investing and making investing more accessible, but we strongly believe that investors need to understand what they're owning and understanding the risks that they're taking inside their portfolios.
All right, Daniel, really great to speak with you on this Friday. Have a great weekend when you get there. That is Daniel Prince of BlackRock. Tune into ETF IQ on Mondays at 12 p.m. New York time. And you can read all about the ETF industry in my weekly newsletter. That is Bloomberg.com/ETFIQ newsletter. But let's bring you some breaking news right now. This coming from President Trump speaking to reporters at the White House. He is due to depart to Texas today. He says that they are treating former Brazilian President Bolsonaro very unfairly. Some comments about Fed Chair Jerome Powell as well. He is saying that Powell is doing a terrible job. We have heard that before, and we will continue to follow that. Just quick remarks to reporters at the White House.
Yeah, and we should say that his remarks are sending the Brazilian real lower, so interesting cross-asset moves on the heels of this dispute, perhaps the most intense between the U.S. and Brazil, being seen as the most intense besides China.
Yeah,
basically.
Exactly. And a real expansion of how this administration is using tariffs. We'll continue to follow that. But coming up in the next hour, Cameron Dawson of NewEdge Wealth joins us, as well as Bess Freedman of Brown Harris Stevens. This is Open Interest.
And And we are 30 minutes into the trading day, and we are in apparently the dog days of summer. We have the S&P 500 down about 0.4% on the day. We are off of session lows, but lower nonetheless, with most major sectors in the red. The Nasdaq 100 also down 0.2%. That 10-year yield back at 4.4%.
Yeah, there you go. It just feels glued to that range as we keep talking about. I will say it doesn't feel like there's much conviction behind this selling that we're seeing. Volume very much below its 20-day average on this Friday morning.
Right. It is a Friday after all. Welcome back to Bloomberg Open Interest. I'm Sonali Basak.
And I'm Katie Greifeld. Matt Miller is out of the country.
And some reasons you might be saying some tough stuff in the market. Another day, another tariff. Remember President Trump announcing a 35% levy on Canada.
And that's why you have stocks pulling back from record highs with earnings season set to kick off next week.
And big banks leading that earnings parade. They are set to post gains thanks to record trading days after President Trump's tariff announcements.
Yeah, and let's talk about that because the president says that he is eyeing blanket tariffs on most trading partners. We know that he's singled out Canada in particular, and in a letter posted to Truth Social, he threatened a 35% rate on some Canadian goods. Now, for his part, you have Prime Minister Mark Carney responding, saying that Canadian governments will defend its workers and its businesses. So let's break it down now with Bloomberg Washington correspondent Tyler Kendall. Tyler, great to have you with us. Actually, just in the past few minutes, we heard from the president himself, of course, speaking to reporters at the White House. We know that he's heading to Texas today, and he had a lot to say about Brazil's former president.
Right, exactly, Katie. He's really doubling down on this idea that he's going to link these tariffs to what he says is unfair treatment of Brazil's former president, Bolsonaro. It's an interesting dynamic here when it comes to imposing on Brazil what would be a threatened 50% tariff. We're talking about the baseline tariffs going up. Brazil had been facing a 10% one. Now President Trump is threatening the global blanket tariffs higher and Brazil's tariffs even higher. But keep in mind, these reciprocal tariff plans are based on the International Emergency Economic Powers Act, IEPA, which is supposed to be justified by this idea of persistent trade imbalances. But instead, President Trump is using the justification here to tie it really back into politics. It's an interesting development as President Trump really does seem to be ramping up his tariff threats and not really backing down if we look at sort of all the different factors that have emerged just this past week, holding firm on the August 1st deadline, ramping up tariffs on Brazil, on Canada, and also making sure that those sector-specific tariffs are still coming down the pipe as well.
Tyler, we thank you for keeping an eye on all of it for us. That is Bloomberg's Tyler Kendall. And joining us now, Cameron Dawson, Chief Investment Officer of NewEdge Wealth. And you look at the new tariff strategy that the president is putting forward. What struck me as well is the 15 to 18% tariff, 15 to 20% tariff rate that he is considering on most major trading partners. 20%, Cameron, seems to be higher than most investors that we talk to are expecting. What would that mean if we get that high?
Yeah, we think that there's a fair amount of complacency amongst investors when it comes to the impact of tariffs on the economy and on markets, simply because there hasn't been any impact to the data yet. If people are looking at the last couple of months, they'd say, look, we've seen a little bit of an uptick in continuing jobless claims. Inflation hasn't ticked up that much, but things like retail sales have really held up. So there really isn't all too much impact from tariffs. However, we think it's probably too soon to make that judgment that a lot of these things are going to take time to work their way through markets. And we heard that from Levi's this morning. Effectively, they're saying that sales are holding up, but they're taking the hit on gross margins, which suggests that if you look at the tariff revenue that's been raised thus far, it's about $100 billion. It may be company margins that really bear the brunt of paying for the cost of those tariffs. But that, again, will take time to work its way through.
Yeah, it's a good point, too. And we actually heard from St. Louis Fed President Alberto Musalem yesterday saying pretty much the same thing, that it's too soon to know the inflation impact of tariffs. So still in a wait and see mode, even if it seems like the broader market doesn't think so. But with that in mind, Cameron, I mean, where do you pick and choose your spots in this market?
Yeah, we certainly want to stay in the higher quality echelons of this market. One of the most interesting things coming out of the April low has been that it has been led by low quality, high beta, very liquidity sensitive portions of the market. And those have absolutely ripped higher. They've returned 40, 50% coming off of the April lows. But what we think is that as you start to see some of the economic and real earnings impact work its way through, this is a great reminder to really focus on companies that have a strong track record of blocking and tackling through uncertainty, looking at companies with strong balance sheets as well, and that resilience in free cash flow generation. So we wouldn't be chasing the low quality, high beta rally. We'd be sticking with the high quality parts of the market.
There seems to be a lot of complacency out there. You've just mentioned it yourself. And one thing that's interesting is that if you look this morning, you had S&P Global Markets come out with a note saying that there has actually been the highest pace of bankruptcies since 2010. And you wouldn't know that by looking at the stock market. So is there some pain under the surface that people are not accounting for?
Yeah, and here we are sitting with triple B and double B spreads, high yield spreads at their tights for the year, suggesting that complacency is not just in equity markets trading at 22.4 times forward, but it's also within fixed income markets. And we think that that really is a function of being in an abundant liquidity environment with so much money sloshing around, chasing an ever dwindling supply of things like high yield bonds or high quality stocks. You've seen this upward pressure on valuations that's hard to beat. And the other aspect of this is that you still have a fair amount of equity investors, a big cohort that remain underweight equities, with the Deutsche Bank Consolidated Positioning Report still just at 30%. So even though you are seeing these risks start to bubble up, even though you're starting to see signs of financial stress, people being underweight markets suggests that they're having a willingness to look through it. And we think that volatility will kick back in once people get fully invested and then look around and say, well, do I really want to pay this valuation for this degree of risk?
Let's continue on with this idea of corporate credit, because you mentioned these very tight spreads. And you're right. If you take a look over a 1 year, a 5 year basis, we are very tight when it comes to blue chip, when it comes to high yield. There was a really interesting conversation on Bloomberg Surveillance earlier this week with Amanda Lynham of Blackrock, and her view was actually that there's a risk that people are being too defensive, that the risk is actually that folks aren't positioned for enough risk, a risk-on move. It sounds like you're taking the other side of that argument.
Yeah, we moved to be underweight high yield earlier in the year, and it was the wrong move, meaning that you've still seen this ever pressure down on high yield spreads. And what we see is that investors look at high yield or look at investment grade credit overall and say the all-in yield is still very attractive, even if the spread is very tight. And the other aspect that you have is that credit issuance has also been really light. So companies have been trying to kick the can down the road, defer their issuance because of higher yields, which means that there's a very little supply of incremental credit. So you're in a world where demand is high because all-in yields are high, but supply is low, and thus we continuously get this downward pressure on spreads. The thing to note is that the volatility to the upside is very episodic, which means that once people start getting afraid of growth, you see a very sharp move higher in spreads, but that is typically a very good buying opportunity to step in and take advantage of those higher yields.
Speaking of higher yields, we have seen the 10-year drift back to 4.4%. And Katie had cited a note from DoubleLine earlier in the year that proved to be very, very prescient. This idea that investors might prefer owning Microsoft bonds over U.S. government bonds. And so far, you've seen a lot of investors seeking safety in the corporate bond market relative to the government bond market. What does this tell you about risk appetite?
Certainly, the full faith and credit of the Azure cloud versus the U.S. Treasury. Look, I think that there is still this underlying concern, and you see it not just in the U.S., but around the globe, of the upward pressure on long duration, long end yields, which suggests that there is some concern about sticky inflation, as well as questions about high deficits drifting higher around the world. And so we do think that bonds play somewhat somewhat of a different role in portfolios in this world of higher inflation and higher deficits compared to the last 40 years of being in a big bond bull market where you could count on yields drifting ever lower, which means that maybe isolating credit risk, as you say, preferring to have the full faith and credit of Microsoft versus the US Treasury seems to be what people are leaning towards.
Yeah, Microsoft, it may not have taxing authority, but boy, like you said, it does have the cloud. Cameron, always great to speak with you. That is Cameron Dawson of NewEdge Wealth. Let's take a look at some of the single stocks moving this hour. We're just about 40 minutes into the Friday trade. We'll do that with cross-asset reporter Denitsa Sekova. And Nvidia, top of mind for investors after hitting $4 trillion. What's it doing today?
It's actually up. In earlier trading, a lot of the Magnificent Seven, actually all seven, were down. And what we're seeing today, which kind of makes sense with the overall market reaction, is resiliency. And Nvidia is up more than 1%. Amazon is up. For example, Meta is seeing a lot of pressure, but of course this is coming after a meteoric rise in the last couple of months. But Magnificent Seven has a very different reaction now to this flurry of tariff headlines we've seen than it had in April. We're seeing all those indices of policy uncertainty showing increase in uncertainty. But indeed, Magnificent Seven is continuing to be strong. Nvidia obviously above $4 trillion. We had that meeting with President Trump. Jensen Huang is going to China now. So there is a lot of optimism. And I think what's prevailing in cross-asset right now is not missing the rally. And we saw President Trump tweeting yesterday, Nasdaq at records, industry at records, crypto soaring, and Nvidia at records.
It's funny. I'm glad you mentioned Amazon as well, because yes, it's one of 4 stocks in the S&P Consumer Discretionary Index that's higher today. The other one that's only higher than that, I just think this is really fun, is McDonald's. And so go figure, you have a market that is sussing out fresh trades. We're keeping an eye today also on cryptocurrencies. You have seen a pretty stunning rise in Bitcoin once again. Coinbase seems to be a big beneficiary.
Incredible rise. Bitcoin is a record high. Clearly, there is no risk of positioning today. We're back. Magnificent Seven is back flat on the day. Bitcoin is at 118,000. We're seeing all those companies, Mara, Riot, Coinbase, rising. We're seeing a lot of support. In Washington, they actually just declared the next week as Crypto Week.
Oh.
We had the stable coin day.
Not Infrastructure Week? Did that ever happen?
No. It's Crypto Week.
You could consider crypto infrastructure, depending on
Yeah, I don't know if I can build a road out of Bitcoins, but Crypto Week next week.
I think it's a sign of the times, right? We have that stablecoin legislation. We have a lot of support in Washington. At the same time, we have institutional investors becoming more bullish on that. We actually had one of the biggest inflows in Bitcoin ETFs as well. So we have retail, institution, and DC. And that kind of explains why some of the biggest winners today crypto stocks.
But you know, just real quick on that, Circle is actually down today, though, on stablecoins because of yet another downgrade.
Circle, you know, it's still up so mightily from its IPO. Let's move from crypto to drones, because also in focus this morning.
Yeah, everything today is moving off news of the administration. We have the Defense Secretary issuing orders to ramp up productions and deployment of drones. Obviously, that's something that President Trump has been talking about a very long time. It's been one of the big trades. For example, I'm looking at Red Cat today. It's up 20%. That's actually one drone company that was down year to date, so it makes sense that it's leading the rally. We're seeing that kind of reversal. But pretty much everyone in the space is seeing a really big gain today. And if you look at the Blackrock Aerospace and Defense ETF, it's up 30% year to date. So clearly one theme that has been a reliable win for investors. And whenever we get news like that, you can see a lot of retail sentiment really shifting very rapidly there, and a lot of bullish options.
Red Cat, activity. Is that a Katie kind of stock?
Yeah, I was thinking about it.
I like cats. I don't know how I feel about drones. I will note it's a pretty small company, less than $800 million in market cap, but having a great day.
Having a great day. There's somebody else having a great day. I will talk about it in just a second. Denitsa, thank you so very much. That is Denitsa Sekova of Bloomberg News. Ken Griffin's good day. Ken Griffin Citadel Securities expands its dominance in market making. We're going to talk about what's happening at the market making firm next in the Wall Street Beat. This is Bloomberg Open Interest. And And now to high interest, a look at what's making headlines around the world. President Trump says he's planning a major statement on Russia on Monday. This is as the U.S. prepares to send more weapons to Ukraine via purchases from NATO allies. In an interview on NBC, Trump criticized Russian President Vladimir Putin over Russia's continued attacks on Ukraine. And Bloomberg has learned that Performance Food Group has attracted takeover interest from U.S. Foods. A potential deal would create a food distribution giant company with combined sales about $100 billion. M&A just taking off. And Treasury Secretary Scott Bessent told a room full of billionaires in Sun Valley that President Trump shares a personality trait with his former boss, the famously liberal financier George Soros. Both men, he says, are impatient when working on high-stakes deals. And Citadel Securities bought the unit of Morgan Stanley that's focused on electronic market making for U.S. equity options. It's a move that further cements the firm's dominant role in popular derivatives, and that is today's focus on the Wall Street beat. We're going to dive into this now with Sridhar Natarajan of Bloomberg News, and it is amazing to see Morgan Stanley sell this business to Citadel Securities. Why would they? Because their rivalry is very, very fierce between Citadel Securities and the big banks. What does Morgan Stanley gain from handing it over to Ken Griffin?
Look, it's interesting that you take that perspective, because the question in my head was I couldn't believe Morgan Stanley was still in this business. And that was borne out in the story, because apparently Morgan Stanley was the last big bank still in the business of electronic market making of U.S. equity options. The thing you have to think about, and when you zoom out a little bit, is when you think about the equities business on Wall Street with the big banks, it's intermediation and financing. Financing is the pocket that's been growing. Financing has been the pocket that's been lucrative when you leverage up your biggest clients so that they can make big bets in the market. Intermediation has not been seen as a high return business. It's more a good value proposition. It's something you need to have for your institutional clients to be a full service player. And when it comes to markets such as US equity options, especially where there's so much retail trading interest, that's built for speed and scale. That's built for players like Citadel Securities and others which specialize technologies. Banks like Morgan Stanley are not in a good position to compete. And once they're pulling out of that space, it's not a surprise that it's Citadel Securities that swoops in and takes those positions.
Shri, I'm comforted to hear you say that, because when I got the push alert on my phone yesterday, that was my reaction. I didn't know that Morgan Stanley was even in this business. And according to Bloomberg Intelligence, they only accounted for around 6% of such payments, which is also a little bit surprising. So now that we have the big banks fully out of this space, talk to us a little bit about the competitive landscape. Obviously, Citadel Securities is the big kahuna there, but what does the rest of the leaderboard look like?
And if you expand beyond just equities, fixed income, you look at players like Citadel Securities and the Jane Streets of the world, IMCs, they are making a bigger move into the traditional space of the big banks, and banks really don't have much of an option. These firms are not tied down by the same kind of regulatory constraints. They have invested a lot in their technology. They can do a lot more with a lot less. Look at the banking infrastructure, the number of people you have, the number of operations people you have to have, and then the regulation and compliance focused people you have. These competitors don't have those headaches.
I want to throw you a curveball, because next week is bank earnings. Goldman Sachs is expected to come out with the highest amount in equity trading revenue. Of course, obviously, we've been talking about Citadel Securities and the competitive nature of it, but there's also all this headline risk around Jane Street. How is the rat race shaping up this summer?
Well, the Jane Street headline risk, at least, it's not so much as to how it affects the rat race, but it is the gloating behind the scenes that you see, not just from the biggest banks, but also the other direct competitors to Jane Street. That's a problem they'll have to solve for. Again, we're talking about the options market. The fact that the options market in India accounts for 80% of the global volumes, that's just a crazy stat that a lot of people didn't appreciate, and it had become a lucrative space for a lot of players. Jane Street will have to figure out how to navigate it. The regulatory landscape in places like India isn't necessarily as predictable as what they're used to in India. And yes, it'll be a bit of a stumble, and the competitors will be happy for it for now. But I don't know if that necessarily changes in the long-term secular trend of where these players have been dominating and have been making inroads.
Yeah, that temporary trading ban for Jane Street in India, I have to imagine that hurts, both from profit making and also reputationally as well. Sridhar, you have a busy week next week. You and Sonali both with bank earnings, so God bless the both of you. That is Bloomberg Sridhar Natarajan. Let's get a check on these equity markets right now because the S&P 500, we're off our worst levels of the section. We're not quite back to positive territory, but the NASDAQ 100, it's gunning for a green day. We'll see if it gets there. Meanwhile, you take a look at the bond market right now. A bit of a sell-off underway when it comes to the long end of the yield curve, currently up about 5 basis points. We'll check deeper into markets next. This is Open Interest.
Now let's get a check on the stock market right now because it has been a really choppy trade under the surface. Of course, there's been headline risk when it comes to the Trump administration and their trade policies, and you are seeing it drag down the likes of Meta Platforms, which we know has been a high flyer this year, but it is the biggest points loser on the day. Same goes for Berkshire Hathaway, Broadcom, Visa, JP Morgan, also down ahead of next week's bank earnings. Now, on the upside, you do have Nvidia hitting new intraday highs today. Amazing since it's already hit that $4 trillion valuation mark, but Amazon also higher. Remember, this was Prime Week and there were some worries, but now we are back on the upside. General Electric, Palantir also higher, contributing to the points on the upside on the day. Let's look at sectors, shall we? Because energy is higher on the day as well, about 0.2% higher. Information technology and consumer discretionary. I've been having a little fun here. This is not only Amazon higher, it's also McDonald's higher. But of course, we are trading kind of flat on that sector. Materials, healthcare, financials, all lower. Real estate also lower. Remember, yields are higher. The 10-year hitting 4.4% once again. That draws a little worry about these financials ahead of next week's earnings. And coming up next, the New York mayoral race is heating up. You might have been paying some attention. We're going to take a look at the impacts the winner will have on the real estate market with Bess Freedman, Brown Harris Stevens CEO. She joins us next. This is Open Interest.
I met with 250 of the 700,000 small property owners. Can you imagine telling a small property owner that you can never raise the rent so that your rent rolls no longer equal the repairs of the building? Those small property owners are going to lose their property. All of these different communities are now waking up and realizing what his policies would do to them individually.
That was New York City Mayor Eric Adams speaking to Bloomberg yesterday. And on that topic, Bess Freedman of Brown Harris Stevens says that there is new stress in the New York real estate market after Zohran Mamdani's primary win, saying, quote, his proposals, such as a citywide rent freeze and ambitious affordable housing targets, have been met with skepticism. Bess Freedman, I'm pleased to say, joins us now. Brown Harris Stevens is a luxury real estate brokerage in the New York metro area and South Florida. Bess, great to see you.
Nice to see you, ladies. Good morning.
So skepticism, I feel like that's a diplomatic way to put it because we've certainly seen responses from all over the spectrum, especially when it comes to some of the real estate proposals. So take us into your world and the conversations you and your peers have been having.
I think it's consistent with what Mayor Adams said. There's real concern about rent freezes, free bus rides. I think he had some sort of rhetoric about defunding the police early on. And I have to believe that he has good intentions, but the consequences would be so detrimental to a city like New York that is just finally recovering from COVID. Remember, 5 years ago, crime was up, homelessness, there were encampments, tourism was way down, people felt a sense of danger, people weren't going into the offices. That has all changed. We had 64 million tourists last year. People are back in the city. You know, things are better than they were before. And to have someone with these sorts of policies, I think it's like ideological mishigas. You know, it's like chaos. He doesn't understand how the city works, and he doesn't understand that we're a business too. We're a community, and we have to work together.
You know, one thing that seems to be capturing the hearts and minds of New Yorkers is just that strong focus on housing. Because, of course, you're having rents hitting another record. More increases are on its way in rent prices. But you listen to his actual policies, some of them, for Wall Street's purposes, are very scary, like rent increases, or rent caps, sorry.
Yes, rent caps.
But there are other policies like deregulation, like tearing down red tape, that seem to be things that people could very much get on board with. What do you think is the viability of him to do that, should he become mayor?
It's you know, it's wonderful, like, to pretend you're a Robin Hood and you can just wave a wand and do that, but it doesn't work that way. I mean, a lot of landlords are sort of, they have this negative connotation like they're bad, but there's a lot of people who have a few buildings that are paying their bills, and something like a rent freeze would be so damaging to them that they wouldn't be able to pay their bills and make repairs. And I don't think what Mamdani is saying he would do is even possible. I don't think he would be able to do the things he proposes, but it sounds good to people because they're desperate. And as you said, rents are at an all-time high, partially because they've gone up since June 11th, something like 15%. And part of that is due to bad regulation, bad legislation. The city council passed something called the FAIR Act, which we've seen a jump in rents, and we warned them about that. But people are so insistent that they know better, they're not listening to their communities. And that's what we need to do better in New York, is come together and talk to each other so we can give expertise and help so we come up with good solutions.
Well, we have to see the outcome of this election, and we know that proposals don't often turn into policies, so we'll have to follow that connection as well. But putting that aside, if you can, I mean, if you take a look at the underlying market right now, we talked about rents, but how does it look when it comes to the purchasing market right now, when it comes to list prices? Have we seen any softening there?
I mean, every time I come here, I want to come in with some great news and be like, guys, everything is better. But, you know, it's not. Prices have continued to go up. I think this is the 23rd month that prices have gone up. Rates have not come down. I think the 30-year is now hitting 7%. Inventory is still tight in many places. So buying a new home, a first-time home, has become almost unattainable for first-time home buyers. So I wish I had better news for you, but I don't. And I think we need to solve the affordability crisis in the United States of America. New York is different because it's discretionary, but the rest of the country, people want to have a first-time home, and we need to make that possible for people.
So we've seen this particular story before. When things get a little tougher in New York, or it looks like it's going to be less business friendly, then you have a group of people that say we're leaving.
Yeah.
And some do, but for the most part, they're crying wolf, right? I mean,
people said that when, you know, Donald Trump became the president, that they were going to leave, and they didn't leave the United States. And people are saying that if Mamdani gets in as mayor, they're going to leave. I'm really skeptical about that. I think this is the greatest city in the world. It's singular in what it does. It's the talent capital of the world. And he can't just enact these policies. He has to work together with people. He has to work with Governor Hochul. He has to work with everyone. And so I'll sit down with him if he becomes the mayor, and I will try to help him to solve problems. The world is not going to, you know, disrupt in New York. It will work together. And I don't think people are going to run out and leave. We've already had that problem because of taxes, because of so many other issues. COVID, people left. But this is New York City. People want to be here.
I want to talk about myself a little bit. I actually just left New York City, and I moved to Hoboken. I feel like I always update you on this.
Hey, I did too, so I can't even, you know.
Yeah. I get it. It's unaffordable because it becomes unaffordable.
Exactly. Saving thousands of dollars just by going over the river. That's between rent and parking. But I want to talk a little bit about pocket listings, because we signed a 12-month lease. I would love to buy in New Jersey, but inventory is so tight right now. And I've had many people tell me you need to get in with an agent. You need to get a broker, because pocket listings are how it's happening, that these houses aren't even hitting the market.
That's
Have
horrible.
you seen that?
Yeah, I mean, we have that. There's this new thing that some brokerages have created, which is called a private listing network. And they're sort of, as Ray, I can't remember his last name, but he championed this phrase where he said, you know, you can't pretend to be the champion of the consumers and gatekeep listings. And so there's this private listing network that sort of keeps the listings in and prevents consumers from seeing everything. And I think that's really damaging to the marketplace. As we know, let me ask you, where do you start your search if you're looking for a listing?
I check the Zillow app religiously.
So Zillow has 2.5 billion visitors a year and growing. And unfortunately for brokerages, they kind of lost this battle. I mean, I'm a brokerage, I understand that, and that's where all the listings are. And we have to try to keep them there so the consumer has their eyes on the listings. We don't want to prevent listings from being there, and we want to make sure consumers get to see everything. And I think this is sort of a goal of brokerages, to try to keep money internal versus keeping it outside. So don't fall for the pocket listings. That's a nightmare that creates a complete boondoggle for everyone. And so we want to sharing. Sharing is caring, as they say. So.
You know, Katie, it's okay. You're renting. I'm stuck with a 6% mortgage. You lose if you do in the housing strong market. You lose if you don't. What are you going to do? We are lucky to be able to be even in the game. Bess Freedman of Brown Harris Stevens, thank you so very much. We're going to get a check on these markets now, of course, because it's been such a strange trading day that we've been looking at. 0.25% lower on the S&P 500, and now we're getting into flat territory on the Nasdaq. We have been struggling between those gains and losses. The S&P 500 on the brink of ending lower on the week, and the 10-year yield now firmly at 4.4% once again. Katie, really interesting dynamic to close off this week.
Yeah, absolutely. Those losses lessening, but breadth still looks really bad when you take a look at the single stock level. So let's go there now with Bloomberg's cross-asset reporter Denitsa Seikova, starting with some good news.
Yeah, some good news from retail. Let's start with Levi Strauss. It's up 10% today. It's coming off the company raising its revenue outlook and expecting sales growth to outgrow tariff. That's something we've seen in the retail space. It's just all about what people say about their outlook on tariffs. We saw what happened to Gap when they projected a $300 million loss. But currently, Levi's is seeing big gains this year. It's up 25%, really one of the best performing names there. The company sees revenue rising between 1% and 2% for the current fiscal quarter. This is significantly more than what the street was expecting. People are saying that their revenue, their efforts to branch into new revenue streams, new products, is doing very well. They have this concept of head-to-toe denim lifestyle. I don't know if you're buying into it, but apparently it's doing quite well. It's
I am
cool.
very much buying into it. Jeans and cowboy boots are my favorite thing.
There you go. I am not. I'm still averse to denim, though I did buy some jeggings recently.
That's part of the trend.
Apparently I'm stuck in 2012.
I'll join you.
Let's move on, though. Let's talk about Canada Goose.
Yeah, another retailer that is doing very well. It's coming off an upgrade from Barclays, from equal weight, and currently they say the risk reward for the outwear maker is more balanced. The stock is up about 4% today, but year to date it's more than 30%. Really remarkable rally there. We saw that was one of the companies that was shaken by the tariffs initially, and then a lot of people came up with the idea that it's actually relatively insulated. Canada Goose said it in their earnings call, and then it obviously emerged as one of the big winners. It sees better margins on operational improvement, highlights the firm's clean inventory. We yesterday had news about Bain Capital actually considering sale of its stake, and we saw a big rally of that news.
So interesting. Yeah, it's up 7 days in a row. It's up almost 30% in just those 7 days alone. To switch gears again, another company having a really good day, AMC.
AMC, a retail favorite, up 10% today. But if you actually zoom out, it's been a pretty tough year. That company has done so many things, jumping on the Bitcoin wagon and doing all those things to kind of restructure. But we're seeing some optimism from Wedbush, upgrading the operator from neutral to outperform. They're also seeing optimism for Cinemark. So there is a lot of optimism for those theater companies, those cinemas. They raised the rating after being neutral since 2023. They said AMC is supposed to benefit from a more consistent movie release. They're seeing growth in the UK, growth in Europe. There are all those Superman and all those box offices coming in. So there is a lot of positive sentiment. That said, the stock is down 17% year to date.
Denitsa, thank you so very much. That is Bloomberg's Denitsa Seikova. And speaking of a little dose of optimism, the latest episode of my Bloomberg original show, Bullish, is out. It focuses on the women of Wall Street. Join the 1 million people that are already watching Bullish. And here's part of an episode featuring Apollo partner Olivia Wassenaar.
You should not feel like you need to sneak out to go to a parent-teacher conference. Like, we all have them, right? You shouldn't feel as though you've got to miss your kid's soccer game because it's 4 PM and it's not quite the end of the workday. Like, we've got to normalize this broader sort of parenting. So first of all, it's not just on the women. It's on the men as well, but it's also just part of like having a long, wonderful career is if you choose to have children, that it's not sort of a secret that you're doing these things.
It's time now for our Wall Street Week conversation. And while U.S. farm productivity and output have soared in recent decades, the country's agriculture sector is expected to record a third straight trade deficit this year. David Weston traveled to Iowa to hear from farmers about how weaker export demand is hurting their business.
A lot of farms, I understand, are actually cash negative. Are you cash positive?
I haven't ran a number to tell you today. Certainly, we know that over the last 3 years, we've seen about a 30% decline in commodity prices. I think over that same time, we've seen the 9 major crops all be underwater, so we are producing at a loss on the 9 major crops.
Gold Eagle Cooperative is an intermediary for farmers in the markets they serve. It is located on the outskirts of Eagle Grove, a short 20-minute drive up the road from Swanson's farm. We sat down there with Tom Halverson, an Iowa native himself.
I remember when my grandfather started, when I was a little kid, he had a little tractor with a harvester that would do 2, 1 on each side. He'd be going back and forth in the field like this for a couple days.
After working around the world for Goldman Sachs, he's now CEO of CoBank, which operates as a farm credit bank, counting as clients both Swanson's Farm and Gold Eagle. Halverson has a front row seat for the storm brewing over America's crop farms.
Corn, soybean, and wheat prices are meaningfully lower than they were a couple of years ago. That translates into, lower cash flows for the producers themselves. At the same time, rural Americans in general and farmers in particular are not immune from macroeconomic conditions, including inflation, for example. They are incredibly exposed to trade, buying and selling internationally. Producers have been squeezed quite dramatically over the last 12, 18, 24 months by a combination of lower commodity prices for what they sell on the one hand and significantly higher prices for the inputs.
Once seen as the supermarket of the world, America is instead finding out the hard way that the world is doing its grocery shopping elsewhere, and has been for some time. This year, the U.S. is expected to record its 3rd consecutive annual trade deficit in agriculture, something that hasn't happened in 70 years. Javier Blas covers commodities for Bloomberg Opinion.
I think that the reversal on the agricultural trade in the United States is a structural feature. I don't think it's going to go away. And there are 2 elements there that are very important. One is that the United States is importing more agricultural commodities than they used to. And the reason for that is that we like to have green beans and strawberries and other agricultural crops the whole year. We don't really want to buy them when they're in season. The other problem is that the United States is starting to export less agricultural commodities, and that is a lot in part due to Mr. Trump's trade policies.
And that was David Weston speaking with farmers in Iowa on the headwinds facing U.S. agriculture. And you can catch Wall Street Week every Friday at 6 p.m. New York time. Looking forward to tonight's episode. Now coming up next, President Trump heading to Texas in the aftermath of the last week's catastrophic floods. We're going to get the latest from Washington next. This is Bloomberg Open Interest.
We're going to see. It was sent yesterday. They called. I think it was fairly well received, but it's what we need. So we'll see what happens.
And that was President Trump speaking to reporters at the White House earlier this morning. And the president and First Lady Melania Trump are on their way to Texas. They will be visiting with local officials and first responders after catastrophic flooding took the lives of over 120 people last week. Joining us now is Bloomberg Balance of Power co-host Kaylee Lines. And Kaylee, talk to us a little bit more about what to expect out of this trip. Of course, we've already heard from the president once today. What does the rest of the day look like?
Well, he, of course, is now en route to Kerrville, Texas, Katie, which is really the epicenter of this devastation. Not just 125 lives lost at least, but still more than 170 that are actively missing. This is still a search effort that is underway, and that's why the president has waited to take this visit until about a week after tragedy first struck so that a presidential visit wouldn't disrupt those ongoing efforts. But we do expect him to tour some of the devastated area around Kerrville. He will be later this afternoon around 2 p.m. Eastern time participating in a roundtable with first responders and local officials. But it's coming against a backdrop of some of those very same local officials being under scrutiny as to whether or not they provided adequate warning to those in this area about the looming weather disaster. It, of course, comes as the administration has also been under scrutiny as to whether cuts to the National Weather Service had anything to do with delays in notification or potential disruptions in staffing and forecasting. So far, there is no evidence that proves that, but it also puts a focus on the president's previous commentary that he's made consistently during his second term about how he would like to see FEMA essentially unwound, that disaster response authority sent back to the states themselves. He hasn't been commenting much on that in recent days. We'll see if we get more from him on that as he makes this visit from Texas today. But that is really the kind of next leg of the story here, in addition to what's happening in Texas, how this could shape the response to natural disasters all over the country moving forward.
I was going to ask about the funding cuts as well. To your point about evidence, there's not any today, but the other question I have about this is coupled with the Supreme Court decision that would lift the gates around funding cuts and layoffs really across government agencies. How does the conversation start to change?
Well, around FEMA specifically, Sonali, you've already seen kind of a change in tone from the administration, suggesting that is policy that is still under review, essentially. So we could potentially see a tone shift there. But overall, there has not been a real shift in terms of the administration's desire from a policy standpoint to pursue a smaller federal government. That's why the administration viewed that Supreme Court decision allowing them to pursue those layoffs as a real judicial victory, as they really are trying to reduce the size of the workforce. We've already had reporting out of CNN today that the State Department, effective today, could fire 1,300 people as it tries to shrink down. So that is still an ongoing effort underway, even as the DOGE has kind of faded to the back burner to a certain extent, especially now that Elon Musk has left Washington. But that is still something the administration is actively pursuing in other areas of government. It's just a question as to how it's going to affect disaster response specifically, especially in the aftermath of a tragedy such as this one.
Yeah, absolutely an urgent question there. But Kaylee, while we have you, I also want to talk about trade policy, of course. That is the concern that's working its way through equity markets right now after that missive being aimed at Canada when it comes to that 35% tariff rate. And it seems like in the letter that Trump penned to Mark Carney, he specified fentanyl. He specified non-tariff barriers as well as being the focus here.
Yeah, it's interesting that the president chose to focus on things like fentanyl in this letter, having just at the end of last month suspended for a brief period of time all trade talks with Canada over the digital services tax issue, which, of course, Canada has walked back from. So it's been very hot and cold here, but he's saying a lack of progress on fentanyl coming over the northern border, though data suggests those numbers are actually very small, is justification for raising the tariff on Canadian goods from 25% to 35%. One caveat I would note, though, Katie, is that there still will be an exception in place for goods that are compliant with the USMCA trade agreement. That is the vast majority of Canadian exports. And also administration officials have told Bloomberg that it is expected that the lower tariff rate on energy imports of around 10% is expected to remain as well. All of that said, none of this is supposed to take effect until August 1st. So there are a few weeks here of wiggle room potentially for Canada to try to work a deal. The very same, of course, can be said for all of the countries who have been on receiving ends of these tariff letters, and plenty more of them could be coming, as the president suggested to NBC News in an interview last night that he could be setting basically a blanket rate on most of our trading partners of between 15 and 20%, which of course is significantly higher than the current 10% baseline.
Higher than a lot of investors are expecting as well. Kaylee Lyons, co-host of Balance of Power. We are looking forward to later today. You are going to be speaking with White House Trade Chief Peter Navarro. That is at 5 p.m. New York time, at a critical time, of course. Markets lower today, so ending on a tough week. But coming up Monday, we're going to talk to Stuart Kaiser of Citigroup, Nancy Tengler of Laffer Tengler, Erica Najarian of UBS. This is Bloomberg Open Interest.